let's talk about placing trades. All these things we've been talking about buying in uptrending market, selling in downtrending market. How do you actually implement that on a chart? So I want to explain that using a few things. I want you to look at this. We said we buy when the market is uptrending or when the market is moving up, and we sell when the market is downtrending or the market is moving down. Okay, so look at this. Let's assume that price is uptrending here, and we had a resistance level that was broken, and then that resistance level is converted to a support, because when resistance is broken, it becomes support. Let's assume that price came back to that previous resistance level that has been converted to support. At that point, a rejection of that level becomes a good place to buy. Okay, so let's assume that we want to buy at this point. Let's assume we are buying at this point. What we expect when we place a trade at this point is that price will go up. Okay. Now, at the beginning of the class, we explained that the Forex market is such a market that you can determine at what level you want to pick your profit and how much you want to risk at any point in time. So look at this. Anytime we are buying, the take profit is usually above the market, because when you're buying, you expect that the market is going up. So your take profit is somewhere above the price at which you entered. And your stop loss, all right, will be below the market. In other words, because you expect the market to be going up in an uptrend, if for any reason your analysis is wrong and the market decides to turn against you and is coming down instead of going up, you set a level at which where price gets to that, or where the market gets to that point, you are willing to pick your loss. Okay, now these two parameters are very important. You must learn to trade with stop loss, and you must learn to trade with your take profit. Okay, so when you're buying, your take profit is above the market and your stop loss is below the market. When you are selling, is the reverse of it. You expect that the market is going down, so your take profit is going to be below the market, and then your stop loss is going to be above the market. That is very important to know. These are the first set of things you need to know when it comes to placing your trade. The second thing is to talk about the lot size or the volume. Now, I want you to have this formula and use it anytime you want to set your lot size. When you are setting a lot size of 0.01, what it translates to is $0.1 per P. Okay, that means if you're using a lot size of 0.01, for every pip movement, it's going to amount to 1 cent. Now, when you're using a lot size of 0.1, it amounts to $1 per pip. Okay, when you're using a lot size of 1, it amounts to $10 per pip, and then same goes for 10 lot size. But I want you to note this. If you are using a lot size of 0.02 now, not 1, all you need to do is just to multiply this value, and that tells you what you're going to have. So let's assume that you want to use 0.02. The dollar equivalence will be 0.1 multiplied by 2. That gives you what? 2 cents. Do you get that? So if we are going to use 0.03, the dollar equivalence is what? 3 cents. Do you get that? Alright, so that's how it works. And this becomes important because you need it to calculate your margin. Okay? You don't want to overtrade on your account so that you're not losing unnecessarily. You want to be sure that per trade, for every trade you place, you are not risking more than 3% of your account balance. Okay? So say for example, you have $1,000 in your trading account. For any trade, you don't want to lose more than 3% of that account, which is 3%, which is 3 over 100 multiplied by 1,000. That gives you $30. So any point in time when you're trading, you should not lose more than $30 on that account. Okay. So your question will be, how many pips should the market move against me, that will give me $30. So in this kind of situation, let's say you are setting a stop loss of, let's say you're setting a stop loss of 100 pips, okay, and we calculated 3% to be 0.3. It means that if the market moves against you 100 pips, okay, you are going to have 100 multiplied by 3 cents, okay, that gives you $30 exactly. So that means the maximum lot size you should use, if your stop loss is 100 pips, okay, should be 0.3. Is that clear? Alright. So that's how it works for placing your trades. We'll go to the chart so that I can show you how to set that. That's first. And then also, I want you to know that when it comes to setting your stop loss, it's very good that you don't set arbitrary stop loss values. You should always place your stop loss based on what the market is saying. Okay. So if you have the market forming higher highs and higher lows like this and coming down and going up, you want to set your price at the level where you know that if the market should go below this point, then my analysis is wrong. But you don't want to set your stop loss at a level where the market can still get there and continue back in the direction that you expected. So those are some of the things you need to take note of when you're looking at placing your trades and setting your stop loss and take profit values. Let's go to the chart and have a look at this.